Joining me now is Eddie Ghabour, co-founder of Key Advisors Group, LLC. Eddie, thanks for joining us on UBS Trending. Good to have you back.
Thank you for having me.
Yeah, good to see you, Eddie. So listen, Eddie, Omicron has been taking the world by storm, and of course it's been holding the markets hostage here and there. So how concerned should we be from an investment perspective as we await more news on this variant?
So look, we know one thing the markets don't like is uncertainty, and that's what this variant really brings. But frankly, in my opinion, I think this variant was an excuse for the market to sell off. Some of the technicals were already breaking down before this news broke. And then once that news broke, it kind of gave the markets excuses to take the risk off trade because it's too early to tell. But everything we've read here early on and based on the medical professionals is this variant is going to be very similar to the Delta variant. So when it happens and it's here now, we are prepared for it. I think the biggest things investors need to understand is these new variants are going to continue to pop up. From a market perspective, the bigger issue is we are now transitioning into a slower growing economy because of the inflationary issues that we have. That's going to really be a headwind next year. So we actually have been saying for the last few weeks that we were going to be selling the rally in this late fourth quarter and really start playing defense by the time we get to the end of January, because we are not very bullish on the first half of next year. And we think a sizable correction is in the cards for next year.
Right. And you know what, Eddie, you made a really good point. There's a lot of comparisons to Delta, but don't forget, Omicron is the 15th letter of the Greek alphabet. So that means there are 14 other variants besides Delta, Alpha, and Beta, which we heard a lot about since this all began. And so, we have to remember that not every one of them became the dominant variant, and Delta remains dominant. So we'll have to wait and see what the scientists and doctors say about Omicron. So, but it is something that is certainly spooking investors in the markets specifically. And then even what about oil prices? Because we're thinking about, look, if travel restrictions ramp up. Which is not to say that will happen, but if for some reason this variant is more transmissible and evades vaccines, depending on what we find out here, what kind of impact could this have on oil, since travel might take a little bit of a pullback, considering that we don't know much yet, and could make us sick if we actually are on an airplane or traveling in trains and cars, things like that. What do you think about what's happening with oil prices?
Look, that's a great point. And I think one of the biggest things that'll happen with this, and it's probably happening already, is consumer behavior is going to change. So I expect to see bookings, cancellations really start to increase here because of people concerned of the unknown from a risk and health factor for sure. And I think that's playing out in oil right now. So, we've been bullish on oil all year long. We did on the 17th of November actually start to trim oil for the first time this year. And I think right now is not a time to be a hero and try to bet on oil having this huge snapback rally, because I don't really think, in my opinion, that's going to happen. So here in the short term, oil, frankly, is probably topped out until this variant is really figured out in the sense of how much travel restrictions are going to be in play. So, oil is going to take a little while to find its bottom until there is clarity there. So, again, now's not the time to be a hero in these highly volatile risk asset classes. Not to mention, if you've been in oil all year, I mean, you've had a hell of a year in this asset class, and booking some gains is probably prudent.
Right, absolutely. And you can even see the markets thought very similarly on last Friday when the Omicron first hit the airwaves after the markets opened following the Thanksgiving holiday here in the U.S. and, saw a precipitous drop. But it's starting to trend a little bit higher again. Again, I think it's a wait and see. But thanks, Eddie. So I wanted to ask you, we're very focused on inflation, obviously. It's still really the biggest story for the markets, as well as all these supply chain issues, especially now that the holiday shopping season is officially underway. The question is, the Fed thinks it's transitory. Do you think it is?
Absolutely not. We've been saying that it's not transitory really since January. And I think the Fed is now starting to, let the market drop hints that they don't believe it's transitory in the sense that it's really going to drop back down. I think what you're going to see is inflation will peak ultimately. The rate of change is not going to continue to increase at the rate it has been. But even if it stops going up and just levels out at the current levels we are, when you look at shelter, that's house prices or even rent, you look at food and you look at gas and you look at auto sales, these prices have gone up at some of the largest rates of change that we've seen since post-World War II. And so this is the biggest issue why we feel like we are due for a double-digit correction at the first half of next year, because the consumer really does not going to have as much discretionary income the first half of 2022 as they did in 2021 because of those four things that are significantly different. And then when you add the fact that the Fed is probably going to have to accelerate tapering and possibly tighten next year. I mean, when you start tapering or tightening while GDP is decelerating, that's the worst equation from a stock market perspective. So I really think it's prudent to enjoy the big gains that investors have had this year and play defense. So that way, when we do have that correction, if we have that correction we're expecting, you can take advantage of it. I'd rather be early to de-risking than late.
Eddie, speaking of the Fed, do you think we're in a stagflationary trajectory right now? Is that something the Fed is going to have to focus on for 2022?
Absolutely. I mean, that's what it looks like we're heading towards here in the first quarter of next year. And I think that transition is going to happen quickly. Look, we'll probably get some type of short-term Santa Claus rally. Consumers are going to spend here in the December months because of the holidays, but reality is going to strike the consumer in January. And when they're sitting down and doing their personal balance sheet, they're going to realize that the cost of living has gone up so much from the prior year that they're not going to have the discretionary income to spend on these items next year. And our economy is based on 70% of it is consumer spending. And if that gets hit, we're in a bad spot.
Absolutely. And obviously, we've got Fed Chair Jerome Powell. We've got Janet Yellen, Treasury Secretary, speaking in front of Congress and the Senate. And, they're going to be talking about the pace of monetary policy and their expectations. It'll be really interesting to see what their thoughts are as far as the acceleration of tapering or the opposite of, and what they decide to do with rates. I mean, the Fed funds futures are looking like they're signaling the Fed may not even raise rates until July 22. I think that has a lot to do with the Omicron variant, but also when you look at the trajectory of inflation and obviously stagflation as a concern, they may have to reinvent the wheel as they go through the first couple of months of next year.
Yeah, frankly, they put themselves in a tough spot because they didn't do anything in regards to tapering when the market and economy could handle it. Frankly, I would have liked to see them while we were accelerating in GDP and markets were healthy to start slowly tapering. But now they've kind of put themselves in a position where if they do nothing, inflation gets worse, and that's bad for the economy. And if they tighten, that's bad for the markets as well, too. So frankly, it's a lose-lose situation that they've set themselves up for. But at the end of the day, the longer they wait to taper, the bigger the bubble gets and the bigger the pain is. So they're going to have to start doing it sooner or later. And I'd rather them start sooner because, again, the longer they wait, my concern is that bubble gets bigger. And when it bursts, that's when it becomes extremely ugly on Wall Street and the economy to Main Street.
Right, and then, but from an investment perspective, particularly with equities in the small cap space, Eddie, what are you recommending right now? Because I know we've been on with you talking about small caps in the past, and you've seen opportunities. But given the expectations that you're talking about for the Fed next year, and the way we see inflation going, do you still think there's opportunity in small caps at these levels?
So look, I think small cap. So there's two answers to that. If you're a trader, they are oversold here in the short term. And if you wanted to dip your toe into the small cap index, you could probably get a decent 2 to 3 week return. But we plan to actually lower our small cap exposure in the month of December. We are expecting a little bit of a bounce because they are oversold here, in our opinion. But we will be selling those rips because if we have the environment that we're expecting in the first and second quarter next year, small caps will probably be one of the worst performers to be in because they're going to get hit really hard with the inflationary issues. So in our opinion, you want to increase the quality of your portfolio. And this is where balance sheets will actually matter. So going into next year, we want stronger balance sheets for the equity holdings in our portfolios and things that we think can really hold up well in a slow growing environment. And unfortunately, small caps does not fit that bill.
Okay, Eddie, great stuff. Always good to have you join us and give your perspective on the markets. Good to see you.
Thank you.